Think back for a moment, if you can, to your first business venture. Maybe selling friendship bracelets or, I don't know, mowing lawns.
Yeah, something like that.
But for a lot of us, I think, the image that really sticks is that classic lemonade stand.
Oh, yeah, definitely.
Remember that feeling, the, handmade sign, coins clinking, that thrill of making your own money.
Absolutely. Pure entrepreneurship, right?
Exactly. So today, we're taking that sweet sort of nostalgic image, and we're going to use it.
Use it to understand something that, let's be honest, sounds a bit complex.
Right. Basic accounting often seems dry, maybe intimidating.
For sure. But we're following this lemonade stand, from the very first coin.
Through its daily stuff, its growth.
Even its challenges.
Yeah.
And you'll see how these core ideas just come alive. And for this deep dive, we're leaning on a really great source. The Accounting Game. Basic accounting fresh from the lemonade stand. It's brilliant, really. It uses that simple lemonade stand setup to unpack these core financial principles.
So it makes it relatable.
Totally. It's designed to create those aha moments, Make it stick. A bit like how we learned back in grade school.
With songs and colors and play.
Exactly. Making discoveries for ourselves. It demystifies things using scenarios you can actually picture.
Okay, so our mission today is pretty clear then. We're pulling out the most important bits, the key takeaways from this source.
To help you get up to speed quickly on the basic language of business.
Right. We want to make accounting understandable, memorable, maybe even a little fun.
That's the goal, without it feeling, overwhelming.
Okay, let's jump in. Where do we start?
Well, the foundation, the balance sheet.
The balance sheet. Okay, so imagine your lemonade stand at one specific moment.
Exactly. Right before the first customer, maybe.
Or, end of a busy day, that's the balance sheet, a financial snapshot.
It tells you what we have and who owns it right then, at that instant.
Got it. And there's an equation, right?
Oh, yeah. The core accounting equation. It governs every balance sheet. Big company, small stand, doesn't matter.
Okay, what is it?
Assets, liabilities, plus owner's equity.
Assets equals liabilities plus owner's equity.
And the golden rule, you ever remember this, the left side always equals the right side.
Always equals the right side. Why is that so important?
Well, it's not just math. It means every single thing your business has, your assets, it came from somewhere.
Okay.
Either you, the owner, put it in, or you borrowed it. Simple as that. It shows the integrity of your whole financial picture.
All right. Let's break down those terms then. Assets.
Assets are what we have. So think about starting cash, maybe $5 from your piggy bank.
Okay, $5 cash. That's an asset.
Right. And that same $5, it also shows up on the right side as your original investment because you own it.
Ah, okay. So it's on both sides in a way. Well, it balances.
It balances. Now, say mom and dad lend you $10 for supplies.
Okay, a loan.
That $10 loan.
Right.
That becomes notes payable. It goes under liabilities.
Liabilities. That's what you owe other people.
Exactly. Who owns it in terms of debts? If you're liable, you owe money. Simple.
Makes sense. So that's liabilities. What's the other part of the right side?
That's owner's equity. This is the other who owns it, but it's what you, the owner, actually own.
So my initial $5 from the piggy bank goes there too, as original investment.
Precisely. You might hear other terms too, like equity, stockholders' equity, net worth.
But they all mean the same thing.
Pretty much, yeah. They all represent the owner's stake.
Okay, so let's recap. On the left, assets, we have $15 cash now, $5 initial plus $10 loan. And on the right, liabilities, we have $10 in notes payable.
Right.
And owner's equity, we have $5 in original investment.
And look, $15 on the left, $15 on the right, $10 plus $5.
It balances, always equals. Okay, I get it.
Perfect. Now watch what happens when you do something, a transaction.
Like buying supplies.
Exactly. Let's say you take $12 of that cash and you buy lemons and sugar.
Okay, spending cash.
Right. So cash, which is an asset, goes down by $12.
Okay.
But you now have lemons and sugar. That's inventory, which is also an asset.
Ah, so inventory goes up by $12.
You got it. So what happened to your total assets?
Well, down $12, up $12, it stayed the same. $15 total.
Exactly. And the balance sheet stays perfectly balanced. It just shows how things move around within the asset side sometimes. One asset turns into another.
Okay, that makes sense. It's like a snapshot, but things can shift within the picture.
Precisely. Now, if the balance sheet is the snapshot,
Then what's the income statement?
that's the movie.
The movie. How so?
Well, the snapshot tells you how things look right now. The movie tells you the story over time, how you performed, say, over the whole week or month.
Ah, okay, so it covers a period of time, not just one instant.
Exactly. Beginning, middle, end. Like a film, it tracks your financial events, your activity.
So its main job is tracking sales, costs.
Yep. And ultimately, whether you made a profit. Let's track our lemonade stand's first week. Say you sold 50 glasses, maybe 50 cents each.
All right, 50 glasses at 50 cents. That's $25 in sales.
Perfect. That's your top line. Now, what did it cost you to make just those 50 glasses you sold?
Let's say the ingredients cost 20 cents per glass.
Okay, so 50 glasses times 20 cents.
That's $10.
Right. That $10 is your cost of goods sold, or COGS, the direct cost of the stuff you sold.
Okay, sales $25, COGS $10.
Now, you calculate your gross profit, just sales minus COGS.
$25 minus $10. That's $15 gross profit.
Exactly. But wait, there's more.
Right, because there are other costs, aren't there? Not just ingredients.
You got it. Those are expenses, costs of just being in business, whether you sell a lot or a little.
Like renting the glasses, advertising signs.
Perfect example. Say $2 for glass rental, $1 for advertising, maybe $2 rent for using the neighbor's lawn.
Okay, that adds up. $2 plus $1 plus $2. That's $5 in expenses.
Right. So now we get to the net profit.
Which is gross profit minus those expenses.
You got it. So $15 gross profit minus $5 expenses.
Equals $10 net profit.
Yes.
That's the famous bottom line. Right?
That's it. Net income, earnings, bottom line. All mean that $10 profit for the week.
Okay, seems straightforward.
Yeah.
But here's a question. Does that $10 profit mean I have $10 more cash in my cigar box?
That is a crucial question. And the answer is probably not.
Oh, okay. Why not?
Because that $10 net profit from your income statement, it doesn't just like vanish, it flows somewhere.
Where does it go?
It flows directly into owner's equity on your balance sheet, usually into a line called something like retained earnings, or in this case, maybe earnings week to date.
Ah, so the income statement kind of explains how that part of the owner's equity changed.
Exactly. It blows up or details how those earnings happen. Sales, costs, expenses, the whole story.
Okay, that connects the two statements. What about inventory?
Good point. Any inventory you didn't sell during the week. Your ending inventory.
Yeah.
That gets carried over, becomes an asset on your balance sheet for the start of the next week.
Okay, got it. So balance sheet snapshot, income statement, movie. Are we done? Is that the whole picture?
You'd think so, right? 2 seems pretty comprehensive, but
Yeah.
nope. In the real world, you need a third leg for the stool.
A third statement. Why?
Because neither the balance sheet nor the income statement really tracks the actual flow of cash perfectly. You need the cash flow statement.
Okay, a stool needs 3 legs. I like that. So what's the cash flow statement's job?
It has one single focus. Only cash transactions.
Just cash.
Just cash in, cash out. Over a period, like the income statement, it ignores all that accrual stuff.
Accrual stuff. What's that again?
Right, so the income statement mostly uses the accrual method. That means you record sales when you earn them, even if you haven't gotten the tax yet.
Ah, like selling on credit.
Exactly. And you record expenses when you incur them, even if you haven't paid the bill yet.
Okay.
It gives a better picture of profitability over time, sure, but it doesn't track the actual cash, which is why you need the cash flow statement.
Because cash is king or queen.
Cash is vital. Let's use some lemonade examples for the cash flow statement.
Okay.
Remember your friend who bought lemonade but didn't pay right away? You had an account receivable.
Yeah.
When they finally pay you that $5 cash, that's a collection.
So it's cash coming in.
Right. It doesn't show up as a new sale on the income statement. You already recorded that sale.
Right.
But it's definitely cash in on the cash flow statement.
Gotcha. What about buying stuff like a fancy newsstand?
Good one. Say you buy a permanent stand and maybe the little plot of land it sits on for $10 cash.
Okay.
And maybe later you add a sink for $2, but you charge it, put it on account.
So no cash spent on the sink yet.
Right. Now, that stand, the land, the sink, those are fixed assets.
Fixed assets, meaning?
Meaning property, plant, equipment, stuff you use repeatedly in the business, not stuff you plan to sell quickly like inventory.
Okay. Stand, land, sink, fixed assets.
Now, this brings up a really important accounting choice. Capitalizing versus expensing.
Ooh, that sounds technical.
It's crucial, though. Let's say you also buy paint for the stand. $2 cash.
Okay.
If that paint is, like, cheap, peels fast, and you know you'll be repainting often, that's maintenance. You'd probably expense it.
Meaning it reduces profit right away on the income statement?
Exactly. Reduces earnings immediately. But that $2 sink you charged,
Yeah, it lasts longer, makes the stand better.
right, it improves the asset, lasts a long time. That $2 cost would likely be capitalized.
Capitalized means added to the fixed asset value
Hmm.
on the balance sheet.
You got it. It increases the value of your stand asset instead of reducing profit right now.
So what's the rule? When do you capitalize versus expense?
General rules are the item has to last longer than 1 year,
Okay.
and it needs to cost more than a certain amount the company decides on. Maybe $500, maybe more.
Yeah.
Depends on the company size.
Got it. Lasts long, costs enough, capitalize.
Yeah.
Otherwise, expense.
Pretty much. Now, if we capitalize that stand,
Yeah.
it won't last forever, right?
No, it'll wear out, sun, rain,
Yeah.
kids leaning on it,
Exactly. So we need a way to account for that gradual loss of value.
and depreciation.
That's depreciation. It's an expense, but it's a non-cash expense.
Non-cash. How can an expense be non-cash?
Because you're not actually spending cash when you record depreciation. You spent the cash when you bought the stand. Depreciation just spreads that cost over the asset's useful life.
Ah, okay. So the $10 stand, maybe it lasts 10 years.
Sounds reasonable. Using the simple straight-line depreciation method, you'd take the $10 cost, divide by 10 years.
That's $1 of depreciation expense each year.
Exactly. So each year, your income statement shows $1 depreciation expense, which reduces your profit.
And therefore reduces your taxes.
Right. That's a key benefit. It reduces taxes on paper, even though no cash left your pocket that year for the depreciation itself.
Okay, that's clever. So it helps match the cost to when the asset is actually being used.
Precisely. More accurate picture of true costs. And you can even use accelerated depreciation sometimes.
Faster depreciation.
Yeah, like methods that let you deduct more depreciation earlier in the asset's life. Saves you more tax money now.
Interesting. Can you depreciate everything? What about the land the stand sits on?
Ah, good question. No, land is generally assumed not to wear out or become obsolete, so land is not depreciated.
Okay. Stand appreciates, land doesn't. Got it.
Mm.
What else shows up on the cash flow statement?
Paying back debts is a big one. Remember that $10 loan from mom and dad? Or maybe you took out a bigger bank loan.
Yeah.
Let's say you pay back $27 on a loan. Maybe $25 is principal, the original amount borrowed, and $2 is interest.
Okay.
Only the $2 interest is an expense on your income statement. It reduces profit.
And the $25 principal repayment.
Not an expense. It doesn't affect your profit. It's just cash out on the cash flow statement, reducing your loan liability on the balance sheet.
Wow, okay, so a big loan payment can kill your cash, even if it doesn't hurt your profit figure much.
Exactly. That's a classic cash crunch scenario. Also, paying yourself a salary, $4 cash maybe, that's cash out, and it's also an expense.
Makes sense. And, taxes.
Taxes. Say you calculate your profit is $12 and the tax rate is 25%.
Wait, 25% of $12 is $3.
Right. So you have a $3 tax liability. It's definitely an expense, reduces your final net profit.
But is it cash out right away?
Not necessarily. You record the expense when you incur the liability, but the actual cash payment to the government might happen later. So it hits profit now, but maybe hits cash flow later.
Okay, lots of moving parts between the three statements.
It all ties together.
Now, you mentioned creative accounting earlier. Where does that come in?
Well, one area is inventory valuation, especially when prices change.
Ah, okay. Like our lemons. Say we bought some early for 20 cents each, then maybe a storm hits, lemon grows, prices shoot up. Now new lemons cost 40 cents each.
Perfect scenario. So you have inventory bought at two different prices. When you sell lemonade, which cost do you use for your cost of goods sold? 20 cents or 40 cents?
Does it matter?
Oh, it definitely matters. For your profit and your taxes, there are two main methods allowed.
Okay, what are they?
First is FIFO, first in, first out.
First in, first out. Sounds logical.
It assumes the first lemons you bought, the 20-cent ones, are the first ones you sell.
Okay, so if I sell, say, 60 glasses worth of lemons.
Using FIFO, your COGS would be based mostly on those cheaper 20-cent lemons. So your COGS would be lower, maybe $12.
Lower cost means higher profit.
Exactly. Higher gross profit. And likely higher net profit, maybe $18 in this scenario. And your ending inventory on the balance sheet would be valued higher because it consists of the more expensive 40-cent lemons, maybe $20 worth left.
Okay, FIFO. Lower COGS, higher profit, higher ending inventory value when prices are rising. What's the other method?
LIFOFO. Last in, first out.
Last in, first out. That sounds backwards. You wouldn't really use the newest lemons first, would you? They'd spoil.
Physically, no.
Yeah.
You'd always use the older ones first. But this is purely an accounting method, a valuation on paper.
Ah, okay. So LIFO assumes.
It assumes the last lemons you bought, the expensive 40-cent ones, are the first ones you count as sold.
So if I sell the same 60 glasses,
Your COGS would be higher, based mostly on the 40-cent cost, maybe $22.
higher cost means lower profit.
Yep. Lower gross profit, lower net profit, maybe only $8 here. And your ending inventory value would be lower because it's assumed to be the older, cheaper 20-cent lemons left over, maybe $10 worth.
Wow. Big difference in profit.
Yeah.
$18 with FIFO, $8 with LIFO. Why would anyone choose LIFO if it makes profit look lower?
Ah, think about it. Lower profit means.
Lower taxes.
Bingo. The source puts it bluntly. The only reason a business would choose LIFO is to save taxes.
So LIFO is good when costs are rising, like inflation.
Exactly. During inflationary times, LIFO results in higher DXGS, lower taxable income. The flip side is, if costs were falling, FIFO would give you the lower profit and lower taxes.
Okay, so it's a strategic choice based on cost trends and taxes.
Correct. And it's important to remember that paper versus reality distinction. You physically use the old stock first.
But LIFO just values it differently for the books.
Right. And the IRS has rules. You can switch from FIFO to LIFO easily, but switching back from LIFO usually requires permission and can have tax consequences.
Do companies tell you which method they use?
They have to. It's disclosed in the footnotes to their financial statements. Always worth checking when you analyze a company.
Good tip.
Yeah.
Okay, now let's shift gears slightly. What about businesses that don't sell stuff, like services?
Great point. Let's imagine a second business. Real Good Lemonade Consulting.
Okay, a service business.
The huge difference. Service businesses generally do not have inventory.
No inventory. How does that change things?
Well, for one, it impacts the accounting methods they can use, especially for taxes. Service businesses can often use the simpler cash method for tax reporting.
Cash method, meaning they only count income when cash comes in and expenses when cash goes out.
Pretty much.
Yeah.
Which can be nice for deferring taxes sometimes. Businesses with inventory generally must use the accrual method we talked about earlier.
Okay. And their income statement looks different too, right? No cost.
Right, no cost of goods sold. Instead, for service businesses, costs are often split differently. You might have cost of statuses.
What goes in there?
Things directly tied to delivering the service. Like for the consulting company, maybe the consultant's salary for the time they spent on that client project, or travel costs billed to that client.
Okay, direct costs of the service.
Yeah, and then everything else falls under general expenses overhead, like sales commissions, advertising, R&D, rent, administrative salaries, stuff you pay regardless of specific client work.
Got it. Similar idea, different categories, because there's no physical product.
Exactly.
Okay, let's bring it back home to the lemonade stand. You mentioned a near-death experience in the source material. Running out of cash.
Ah, yes, a classic crucial lesson. The stand looked profitable on paper, had decent retained earnings.
But the cigar box was empty.
Pretty much. Couldn't buy more lemons. Almost went under.
Why? If it was profitable.
And this, right here, is possibly the most critical takeaway from this whole deep dive. Are you ready?
Lay it on me.
Earnings are not cash.
Earnings are not cash.
On a daily basis, CCAS-H runs the business, not profits.
Okay, explain that more. How can you have earnings but no cash?
Think about it. Profits, or earnings, tell you that your sales were more than your costs over a period. You earn value.
Right. That sounds good.
It is good. But where are those earnings? Are they sitting as cash in the bank? Usually not.
Where are they then?
They're typically tied up in the business. Reinvested. They might be sitting in your inventory that hasn't sold yet.
Ah, okay.
Or tied up in fixed assets like that new stand you bought. Or maybe they're in accounts receivable money your customers owe you but haven't paid yet.
So the profit exists, but it's not liquid cash I can spend.
Exactly. It's represented by assets on your balance sheet, but it's not necessarily spendable cash. A business can be reporting fantastic profits.
And still go bankrupt because it can't pay its bills.
Absolutely. Happens all the time if cash flow isn't managed carefully. Understanding this distinction is just paramount for anyone in business.
Wow. Okay. Earnings is the score, cash is the fuel.
That's a great way to put it. You need fuel to keep the engine running, no matter how good the score looks.
Got it. That's huge. One last thing on inventory. What if it just goes bad? Like literally rotten lemons.
The first in, still here, rotten scenario. Or fifth Aish, as the book calls it.
Feich inventory.
Okay. If inventory becomes unusable, spoiled, obsolete, damaged history, You can't just leave it sitting on your balance sheet pretending it's worth something.
So what do?
You have to write it off.
Write it off.
Yeah, you remove it from the inventory asset account on the balance sheet, and you record a loss or expense on the income statement, which reduces your earnings.
So it corrects the books to reflect reality.
Exactly. And the implication is important. If a business doesn't write off its bad inventory.
It's overstating its assets, and its earnings look better than they are.
Precisely. It makes the company look healthier on paper. That's why, if you're thinking of buying a business.
You should physically check the inventory. Look for dust.
Definitely. Kick the tires, look for the cobwebs, check those dates, see if the value on the books matches the real-world condition. It's an area where, shall we say, creative accounting can sometimes hide problems.
Good practical advice. Well, we've covered a lot.
We really have.
Starting with that simple lemonade stand. We've gotten into the balance sheet snapshot.
The income statement movie.
The essential cash flow statement. Concepts like depreciation.
FIFO versus LIFO inventory.
Service versus product businesses. And maybe most importantly,
profit versus cash. Earnings are not cash.
It feels like a pretty comprehensive toolkit for understanding the basics.
And it really is. If you zoom out, these aren't just quirky rules for a kid's stand.
Right.
These exact principles apply everywhere. Your local coffee shop, a giant multinational tech company.
Yeah.
The accounts get more complicated, sure, but the fundamental logic.
It's the same. Assets, liabilities plus equity. Income statement shows performance over time. Cash flow tracks the actual cash.
You got it. Understanding this stuff really is like learning the language of business. It's a shortcut to being much better informed.
Absolutely. It feels much less intimidating now.
Go.
So as we wrap up, here's something for you, the listener, to think about. If cash is truly the lifeblood, the fuel, and profits are the scorecard, how does really understanding that delicate dance between them change how you view financial success, whether it's in that nostalgic lemonade stand or in the biggest companies shaping our world?